Professional traders strip their charts bare to see the truth, but Al Brooks keeps exactly one line: the 20-period exponential moving average. Most traders clutter their screens with oscillators, bands, and clouds, searching for a magic signal. Al Brooks, however, argues that you only need price action and one reference point to understand market structure. That reference point is the 20-period exponential moving average, or EMA. Why the number 20? It isn't mystical. It is simply a standard institutional setting representing roughly a month of trading on a daily chart. Because institutions watch it, the price respects it, creating a self-fulfilling prophecy of support and resistance. Unlike a simple moving average, the EMA places more weight on recent data. This reduces lag and makes the line more responsive to sudden price shocks. It tells you the fair value of the market right now, not last week. The first function of the 20 EMA is trend identification. If the EMA is sloping up and price is consistently above it, you are in a bull trend. Do not look for shorts. The gap between the price and the EMA shows the trend's momentum. However, markets cannot move away from the average forever. Think of the EMA as a magnet. When price moves too far away, it becomes overextended and must eventually pull back to the mean. This is the concept of mean reversion. In a strong trend, the 20 EMA acts as dynamic support. Institutional algorithms often have buy orders sitting right at the 20 EMA line. When price pulls back and touches the line, these orders trigger, bouncing the price back up. This leads to the 20 gap bar by setup. In a strong bull trend, you will eventually get a bar that has a high completely below the EMA. This is a sign of waning momentum, but counterintuitively, it is often a buy signal. Why buy when the price drops below the average? Because in a strong trend, the first deep pullback is usually seen as a discount by institutions. They bet that the trend will resume to test the previous high. Let's look at the logic of the first touch. If a trend has gone 20 or more bars without touching the EMA, the first pullback to the line is a high probability entry. The market is urgent, and traders have been waiting to enter. However, context is everything. The 20 EMA is only useful when there is a trend. In a trading range, the EMA becomes flat and the price oscillates around it repeatedly. In this context, the EMA provides zero value. Recognizing this state is vital. If the candles are chopping through the EMA, closing above, then below, then above, stop using trend strategies. You are in a barbed wire market pattern, and trend entries will fail. Let's refine the entry technique. Al Brooks rarely uses limit orders at the EMA. He uses stop orders. He waits for a signal bar to close at or near the EMA, then enters when price breaks the high of that signal bar. This confirmation is crucial. The EMA is a zone, not a concrete wall. Price often dips slightly below the 20 EMA to run stops before reversing. Waiting for the signal bar prevents you from buying a falling knife. We must also discuss the moving average gap in bear trends. If price stays below the EMA for many bars, bears are in total control. As long as the highs of the bars do not touch the EMA, the bearish pressure is intense. When the price finally rallies to touch the EMA in a bear trend, it creates a moving average gap bar sell setup. Bulls take profits, and bears initiate new shorts, expecting the trend to resume downward. The slope of the 20 EMA is your first filter for any trade. A steep slope indicates a strong trend where you should only trade in the direction of the slope. A flat slope indicates a trading range where you should buy low and sell high. Let's examine a double bottom bull flag using the EMA. Often, price will pull back to the EMA, bounce slightly, pull back again to the EMA, and then launch. The EMA acts as the floor for this double bottom pattern. Why does this happen? The first touch absorbs the selling pressure. The second touch confirms that there are no more sellers left at that price level. The EMA provides the visual reference for this depletion of sellers. Another powerful concept is the EMA gap breakout. If price breaks a trend line but fails to cross the moving average, the trend reversal has likely failed. The EMA is the final line of defense for the trend. This relationship between trend lines and the EMA is vital. A break of a trend line is just a warning. A break and close beyond the 20 EMA is a change in market character. It signifies a shift from trend to trading range. Al Brooks also warns against buying the close when far from the EMA. If a large green candle closes far above the EMA, amateur traders buy the close. Professionals wait, knowing the rubber band is stretched too tight. This is called a climactic exhaustion. When price is farthest from the EMA, the risk is highest. You want to enter trades when price is close to the EMA, low risk, not when it is far away, high risk. Advanced traders use the 20 EMA on higher time frames to find levels on lower time frames. The 20 EMA on a 60-minute chart often acts as a major support level on the 5-minute chart, even if it's not visible on the 5-minute settings. However, keep it simple. If you are day trading, the 20 EMA on your current time frame is usually enough. It captures the psychology of the traders you are directly competing against right now. A common mistake is treating the EMA as a hard signal. It is not. It is an area of value. If price overshoots the EMA by a few ticks, the setup is still valid. Do not demand perfection from an imperfect market. To summarize the Al Brooks approach, the 20 EMA is the baseline. Above it with upward slope, buy pullbacks. Below it with downward slope, sell rallies. Flat, fade the extremes and ignore the middle. Remember, the EMA doesn't predict the future. It summarizes the present. It tells you who is in control, the bulls or the bears, and whether the market is trending or balanced. That context is what makes a trade profitable. Start by adding the 20 EMA to your chart today. Watch how price interacts with it for a week before placing a trade. You will see the invisible structure of the market reveal itself. Master the 20 EMA to see the trend's true strength.